So, should we buy or sell natural gas? First off, read this disclaimer carefully. And do your good deed of the day by liking and subscribing. So natural gas, it is a fossil energy, 170% from the 52-week low, 9% away from the highs. And this is the data from the UNG ETF. So I will analyze the natural gas futures, but there is the ETF alternative. And it's, it's a pretty decent alternative as well. So there were these time cycles here, so let me just draw them in. So there have been different time cycles in different periods. So if I draw the time cycles like this, then they do match price action pretty well. Rise, decline, rise, decline, rise, decline, rise, decline, rise, decline, and the time cycle suggests that we are, we are a bit over the middle actually. So the declining phase is, expected to extend into May here of 2024. This decline here was very substantial. Here as well, we peak a bit towards the middle. So these time cycles, they just have been rather predictive. Obviously, there is a very special situation at this point. Then again, these are many, many years. You have the war in Iraq, you have all kinds of wars really all over the place. All kinds of, big, shock events that were very disruptive to the natural gas market. But the time cycles have played themselves out nonetheless. So something to just consider. Looking at the daily data points here, very strong rally, but we are seeing some exhaustion here in the candlesticks near the top. Also here in the weeklies, you can see that. So let me just draw it in. So this is a very clear uptrend where we close towards the upper end of the candlestick. But you can see that some of these recent candlesticks, so even though price has gone higher, there were people holding the bag way up there. So there's a bit of a change. If you look at some of the previous rallies, like here is a very clean momentum rally. But then you can see that there are people left holding the bag, and what is followed by that is a substantial pullback. So something to have on our radar. So let's look at these indicators here to the right. So I mean, looking at the MACD here, it's extreme. The previous times we had this kind of MACD was back in 2008. So let's look at. Let's go all the way back here to 2008. So here you had, a very strong rally, a similar MACD. After, that peak, we got a very significant sell-off of minus 83%. So a very good time to short natural gas. This is in 2005. Yeah, so here you have, and here you get, the MACD sell signal, final push, and then a major sell-off. Looking at the RSI and the PPOs, we do have readings that have been more favorable historically to bears than bulls. It is interesting. Daily data points, I do get a very similar message here on the dailies. So if you look here at the blue PPO, it measures the distance between price and the blue 100-day moving average, and the red PPO is the 200-day moving average. Previous time this extended was here, and it was followed by a very substantial correction. So this correction was minus 45%. I mean, you are definitively going to feel that, if you are long. Here as well, similar readings, and we did get all the way down here, frankly, minus 34-ish pullback. So I am writing here in the laboratory overbought RSI and PPO, and we have time cycle, time cycles, and the bearish phase is expected. So I will give the technicals here. What will I give them? So purely technicals, I think I will give it a -6. But that is pure technicals. Obviously, there is a macro context, but this is the technicals. Let's look at the seasonality. So to the right here, we have the data over the average data over the last 10 in red, blue in, 7 in blue, and in green over the last 5 years. So over the last 10 years, this usually is a peak. We see bearish seasonality heading towards August. Over the last 7 years here, it's a bit more messy, but the bears usually come back with a vengeance here towards August. But over the last 5 years, then we have seen pretty bullish seasonality. So to the left here, over the last 5 years, in June is one of the weaker months, but on average we do close higher, and July and August are stronger. Over the last 10 years, June is mediocre, July is the weakest month. And the last 20 years, here you can see it yourself, bearish seasonality towards July. That is interesting. So the most recent seasonality has some obviously bullish tendencies, but the bigger picture is bearish. So yes, the seasonality is actually bearish for the coming months. So when it comes to giving the fundamentals a score, the big question we have to ask is, what is not priced into natural gas futures at this point? Because obviously, the war has been in the news. The supply chain issues have also been in the news, meaning it is priced in. And this is why when it gets very complicated, because either it is too much is priced in or too little. I do think that purely from a fundamentals perspective, I will give a little point here to the bulls. So let me give the bulls a 1. So there is a bit of a possibility that it could get even worse. So let's look at relative performance. So we have 69% correlation with the S&P 500, minus 39% with the Russia stock market ETF. And then we have, but due to all of the boycotts, stocks, being delisted, it's a bit of a chaos. Hence the RSX is not necessarily that, informative, because this is, a collection of stocks. The natural gas market is, it's just a pure commodity, and commodities are, very different from stocks, obviously. So. But these are the correlations. 58% positive with XLI, and that is the consumer discretionary ETF. So the theory is that higher gas prices, it's going to be bad for the consumer. So as such, when a clear sign of that would be that there would be a negative correlation. And we have seen that there's been some periods here with a negative correlation as well. So, but yeah. Let's here look at the dollar index correlation at 25%. Daily data point. So here it gets interesting when it comes to the XLI. So we have a minus 76% correlation. So higher natural gas futures price is very bad for the consumer. That's the logic here. RSX minus 70% correlation, and then minus 76% with the S&P 500. So yeah, because when people need to spend a bunch of money on energy, it means that they have less money to spend on other stuff, which will be bad for stocks. Because the most companies, they sell things that you don't desperately need, but you do need energy desperately. But you don't just absolutely must have that Netflix subscription. You don't need frantically to have a Coke, but some like to drink some Coke, but it's not an urgent basal need. 88% 88% positive with the dollar index. So when it comes to the correlations here, it's a bit interesting to look at the XLI because we do have that, at least shorter term, the negative correlation, meaning that they do move a bit opposite each other. So let's look at the weekly data points here. So this is basically the consumer. Yeah, we do have an interesting potential support level here with the 200-week moving average in red. During this week, it was a bit of a support level here. We do get above it. It's messy. It's a war zone for the bulls and the bears. Looking at RSI, we are at a low that has a tendency to at least lead to a mean reversion. And even if we are in a full bore bear market, we could easily have a rally that goes up here to this blue 100-week moving average. We go up there, then meet resistance, and then go down. That is completely normal in a bear market. So just having a bear market, having a recession, having even a depression does not mean that you will not have rallies. That's very important to just understand, because people have this idea that, well, if you have a bear market, then the stock market is going to go like this. It doesn't work like that. It's going to go like this and like that. So basically, we will make new lows, but there will be rallies throughout, and many of those rallies will be interpreted as the low. We saw something similar with so let's very quickly look at the S&P 500 and the global financial crisis. So here as an example, this is in 2008. And during this rally here, many people thought that, oh, it's the low. We're not going to have like a ferocious bear market. But then we go lower. So there were times throughout that, people thought that, oh, the low is in. Here is the relationship between natural gas and the consumer ETF. So we do have a pretty substantial rounding bottom that's been playing out here in a meaningful way here for the bulls. Still, potentially significant upside. If we are going to challenge, the highs here of 2008 and 5. The problem for the bulls is that when we look at RSI, it is very rare for RSI to get even higher. So usually this is a good time to sell your natural gas position and buy into consumer to the XLI, to sort of do a bit of a rotation. So here we did see that high pullback here, and we saw that natural gas weakened against the consumer ETF. I mean, the trend is pretty darn clear. Looking purely at RSI, I'm not really feeling that bullish going forward, in terms of the natural gas futures. Looking at the daily data points, what does the seasonality prophesy? Over the last 10 years, natural gas weakens against the consumer ETF towards the 17th of August. In blue, over the last 7 years, towards later July, but in green here, over the last 5 years, the recent strong moves in natural gas, it's been, bullish. Well, it's improved, that shorter-term seasonality. Here is the relationship between the consumer ETF and the S&P 500. This is just a mess because, so let me just draw in what I see. So here you have double bottom, nice bullish, double bottom, and it's bullish for the consumer, but the problem for the bulls is that this low is higher than this one. That is not bullish. Then again, RSI, it is coming from a level that has a tendency to result in significant, a period of mean reversion to the upside for the consumer ETF. So let's let seasonality be the arbiter. Yeah, and seasonality tells us that, yes, there usually is some outperformance from the consumer ETF, but it peaks rather early, towards 11th of July. So I give -4 to the bears on relative performance. We did find some interesting stuff here. So we do end up with -3.3 in favor of the bears. So even though it's obviously gone up a lot, the bulls are technically still very much in control. We have very overbought RSI and PPO. We do have negative time cycle. Seasonality is bearish. So there is reason to expect downside, but obviously it's been difficult to short natural gas. So if you are going to short it, have any kind of bearish trade, you obviously want to use stops. A more capital efficient way to be bearish on nat gas is to get into the options market. Okay, so if you want more info, then go to DiamondArm.com.